that's for all loan, the packaged loan rather than on a loan by loan basis, or can you find the loan and the stop losses to a particular loan?
Well, you couldn't. You probably could, but the bank's probably not going to let you. Not necessarily, but for the first, so a big issue we're having with the AmTrust takeover is that, especially the bigger deals, everything goes to FDIC committee, and so it's subject to FDIC approval, even though it's still on the books of the bank, and that's where you get into the stop loss provision stuff. So you're kind of just, to a certain degree, taking shots at it and seeing how it plays out. It's probably the best that I could say. So could you pin down to say, where can I nail them to a price? I don't think that I could help you do it.
As you ask a question, will you please use your name? I've got one for Richard Fisher. Now that the euro is almost par, what is the outlook of the European, especially the people out of Germany, about buying failed real estate or real estate in the U.S.?
They're not typically buyers of failed real estate, although there were a couple of funds that were developed in the last year or two that tried to go in and buy notes, debt, but Europeans are typically very slow to respond to offerings and don't like to get into an environment where they're one of 100 buyers pursuing something. They are coming back. We represent high net worth Germans in Germany. We've got about 45 properties of theirs scattered from Boston down the East Coast all the way over to Dallas, and then here in the Florida market. We've got some that are looking for what we would consider a Class A, Class B property, but they're really looking at gateway cities, Washington, D.C., New York, Boston, not Atlanta. They are looking some in Miami because of the industrial base, distribution centers. But they're not the panacea of, hey, we're going to come in here and bring all this capital in. I will say they are starting to suffer the same problems that we in the United States have been going through for the last couple of years. The typical German profile is they buy a property and they have 40 to 50% equity. And most of their funding comes from local private banks in Germany. Those loans are starting to renew, and those banks, they never used to be recourse loans, and they're now going back to their clients and saying, we want you personally on these notes. And that is a change. And the biggest problem the United States has to go through with the rest of the world in terms of investment, there's a stigma attached to this country. They feel it's the epicenter of what's caused all this problem. It's a lack of trust and faith in the American economy. But I think once that corner is turned and they see that our economy does have some resiliency to it, and Americans are known for getting up and dusting themselves off and going at it again, I think you'll see a flow of money coming back here.
Question? Your name and question?
Yeah, Ed Light. Maybe to Richard. Is it the Germans? Who's buying American real estate now, if anybody? I mean, from overseas.
Insurance companies still have to invest funds. Large cap. There's a lot of pools of capital out there, but there's not a big velocity of transactions occurring out there. There's some nice property out in the market. The challenge is for people is to finance it. And we've gotten used to the CMBS environment where the interest-only, partial interest environment, and we got to get off of that back to what we were back in the 70s and 80s, where it was typical to have a 70% loan to value. It's not all that bad. I believe in corrections, but then again, I'm on the investor side.
Question? Dave Repka?
I'm David Repka with Bison Financial Group in St. Petersburg. This is a question for Gary. In the RTC FDIC era, apartment properties were trading A properties at a 10 cap, B's at 11, C's at 12, 13 plus. Where are you seeing properties trading today?
That's a tough question because there's currently right now for just pure apartment communities, because there's so much fewer of them now because so many were fractured and failed condos. There's a lot more demand for those pure apartment communities than there is supply. You know, the example given a little while ago of the Class A apartment in downtown Bradenton, they put it up for sale. They had 40 offers on it. They sold it for 5.5 cap rate. cap rates, I'd say, you know, for the institutional buyer, for the Class A's, they're probably not 5.5, but I see a lot of people saying they're willing to buy that for 6, 6.25. Probably add another basis point for each class going upward. But a lot of that, you know, I hear people talking about going back to realistic underwriting standards. I think a lot of these that you're seeing being bought right now aren't necessarily realistic standards, but there's so much money chasing pure apartments. I think there's, you know, if you're looking at, say, cap rates for fractured deals or fractured condo deals, which obviously is still able to establish an income stream, I think that market's substantially different. I think there you're back to looking at, you know, if you can find ways to make them work through tax reduction and getting the proper rentals, that there's, you know, 9, 9.5, 10 cap rate buyers for plenty of that property. I don't know if that answers your question or not.
Well, and you're financing those how?
You're not.
All cash.
You're right.
Just like I said, our Canadian client, we're also very good friend of Queens. I mean, he's, you know, he's very wealthy, number one, but I mean, he can bring, you know, Canadian capital in here. He's borrowing at 2.5%.
And he'd rather pay cash, because I've had that conversation with him. He said, hey, because you could get some local financing, you know, and even on some fractured properties that he bought. And, you know, when you say, well, you know, what's it going to cost me here when I could borrow it at, I think, you know, around 2.5%. He says, you know, I don't want your money.
Of course, I don't like the sound of that.
Questions? Go ahead, yes, sir.
Yeah, Alan Frazier for Chris. I read somewhere about a single asset real estate, chapter 11 or 13, and I guess my question was, if you go into single asset, chapter 11, can the creditor go after the debtor's other assets?
That is a good question, and it depends what is being bankrupt. So, if who are you bankrupting? Are you bankrupting the
Let's say a
individual?
shopping center or something that's separate.
Well, so oftentimes it will be some separate entity that where you've got, and it comes into a corporate question where, you know, your investment as the member of an LLC, your liability should be limited to your investment to a certain degree. So if you bankrupt the LLC for the purpose of some form of restructuring, debt or whatever it is, you should not be able to bring in the ancillary assets of other members or something to that effect. If you bankrupt an individual who's trying to save something, then arguably the other assets of the individual. So if I bankrupt myself versus bankrupting my LLC, well, it's the typical case of a single asset.
Okay, but I mean, let's say the LLC owns the asset, but the person signed personally.
It's a different bankruptcy. So now, if it's failed, and it still fails, and that may be a reason why the Chapter 11 may fail for a secured creditor, because the secured creditor still wants to pursue its interest against the individual.
Okay.
There's a lot of bankruptcies. It's kind of the Wild West right now. A lot of folks are using bankruptcy to bring the bank to the table to talk for some kind of workout, and so you're seeing a lot of bad faith bankruptcy filings, and the judges are kind of irritated with it. Fortunately, today was not one of those.